So starting at the far end, please introduce yourself and then tell us why debt has been creeping in the past 4 or 5 years, slowly making an appearance, why that's so important.
I feel like I'm under attack because I've been nominated to start and suddenly all the light is on my face. But glad to be here. My name is Jacqueline Iminza Anyamba. I'm with East Africa Private Equity and Venture Capital Association. For those of you who are familiar, I know you're used to EAVCA or EAVCA, but there's private equity in there. And we are an umbrella body for private capital investors across East Africa. So our work is to support capital deployment into local businesses across East Africa, catalyze investments, and ensure that the right businesses are getting access to financing. To answer your question as to why I think there's an increasing appetite for debt financing, I think one of it you've already touched on, the issue around having African founders who don't own the businesses, but building for someone else. So dilution for founders is a key component of that. And the question here is, when you look at equity, are businesses able to raise funding at the right valuation, right? So debt provides that opportunity for these businesses to keep building without dilution, but again have access to the working capital that they need to extend their runways as they still raise their valuations and prepare them to be able to, when they finally take on an equity round, they're able to do it at the right valuation, at the right terms. There's also shared understanding or sentiment that it's the language that some of these businesses understand the most. In some places, especially in the frontier markets, fundraising is relatively still a new concept. And so when you throw in equity and the first thing these guys have in mind is, I'm not building this, there's attachment issues. So I'm not ready to lose a part of my business and there's no way I'm taking on equity. So it's more of innovating and on the investors' side, looking at how do we build funding instruments that are fit for the market, that are appropriate for the market. We also know that there's not a lot of financing options, especially the traditional models coming from especially the banks who would be providers of debt, because these businesses cannot access, the collateral demand is too high. And so venture debt is just coming in to plug that missing needle, the gap that these businesses still need support, they still need access to financing, but what is really the right appropriate kind of funding they need at the particular time or stage of development they are in to enable them to continue scaling and to enable them to continue reaching access to not just markets, but also to be able to access and unlock more financing.
Very comprehensive. Thank you very much. So on to you, Joel. So please introduce yourself and let's take on the banks. Why isn't this the job of banks? We trust them with our money. We put our salaries in there. We bank with them as a small business. Shouldn't you extend a loan to me at the right time? You know me already. You've got the information of all my transactions. You can run a credit model on me, which is specific to my business, and yet we see banks not acting. So why and how do we in this room fill that gap?
I love that question, thank you. To introduce myself, I'm Jill Kerr, Managing Partner of Misfit Ventures. Myself and Egla and Tumba are raising a $4.5 million debt fund that provides 20 to 30 female-led SMEs in Southern Africa to access the working capital and supply chain finance they need to scale. And to answer that question of why aren't the banks there, it's interesting that the banks are still the primary lender to SMEs, but only 20 to 30 of the SMEs in Africa have a line of credit or a bank loan. And if you look at South Africa in particular, only 3% of our local banks' credit loan books go to SMEs. And it's because in South Africa and across the board as well, is they don't credit rate the SME, they credit rate the founder. And when you're a founder, you might not be paying yourself a decent salary, and so your, bank account does this, and you start to look really, risky. The other thing is that the requirements that they need, kind of the collateral-based lending that you pointed out, means that you start not being able to access more of the market. You need to have an entrepreneur that owns their own house. You need to have them have a partner that also is earning a second income so that they can fund this debt. And it means that they just continually see SMEs as too risky and something that they don't want to take advantage of. So even though we all think that you should be able to be banked, from your local bank, they can see, it's actually that they'll only look at your bank account. They won't look at your business bank and say, oh, okay, there's definitely a cash flow issue here that we can plug.
Thank you, Joel. On to you, Olu. So I'm obviously an equity VC, and you guys are disrupting my mandate, right? Because I can get more equity into these companies, even if I am just funding operational costs, which is the most expensive financing option, but I get more equity, I get better returns at the end. So there's a lot of VCs here at this conference. You're a threat to us. So please tell us who you are, what you do, and why we should not see you as a threat.
Well, you shouldn't see me as a threat because I'm also a VC. So I write equity checks into companies as well. So I'm Olufemi Oyinsan, one of the general partners in TCVP, the Continent Ventures Partners. So we're an early stage, largely sector agnostic VC, funding tech-enabled companies across the continent. So we have portfolio companies spread north, south, east, west, everywhere in Africa. And I think till date we funded about 31 companies and have had a few successful exits. And when I think about debt and mezz on the continent, because most of all the checks you've written into these companies have been USD denominated. We raise the funds in USD, but the obvious mismatch is majority of the companies then get their revenues in local currency. So I think that's a major part of debt financing that needs to be addressed, right? So when there's a devaluation, like always, and has happened, I think the currency across the continent, the major markets, Egypt, Kenya, Nigeria, South Africa has taken a beating over this years, then it becomes harder for these companies, to keep up with their obligations. And if you look at the capital stack, many of them would have done better plugging the equity gap with debt, especially the ones who have run a capital efficient business and are actually able to meet their obligations. So it's very welcome development. It protects people like you and me if they get debt rather than an equity, and the dilution is minimal, and the guys with real potentials can realize it.
All right, so I want to go back to basics a little bit, which is around, let's just define what debt is. What are the different products that we're talking about? Because it could be working capital, it could be junior loan, it could be junior debt, senior debt, it could be mezz, it could be revenue-based financing. So from all of you, let's just sort of quickly break down those products, and I'll go maybe that side again. Working capital, what is it? When is it most used for?
So as an ecosystem builder who interacts with both investors and the businesses, I think a lot of businesses need working capital, especially in their very early stage of development, when they are considered very high risk, or better yet, not bankable yet to a commercial type of investor. But even at that point, I've seen that, or rather, I do believe that it's important for there to be a sort of blend in terms of, getting that working capital, and in what form does it come? You've mentioned on issues around repayment, and we know it also becomes a challenge to most of these businesses. And so what I would say is, even with the presence of working capital, I think a lot of these businesses do need some sort of blending of the different forms of available debt, whether it's revenue-based, because revenue-based financing, there are other issues around it, right? Like there are not many structured frameworks to, for example, protect around issues to do with bankruptcy, yeah, when businesses go bankrupt, and this is both on the investor and investee side. So blending different forms of, having different components. You have mezzanine, a bit of, you have revenue-based financing, but also even with this, throw in a bit of concessional capital, to just provide a bit of buffer. So that's how I would define an ideal sort of debt financing for these businesses, and especially in Africa where the cost of capital is too high, one, and there's not enough of domestic capital participation in the ecosystem. And we still need to look at how can we then leverage a bit of concessional capital to de-risk the businesses and then groom them now to be better placed to absorb the other types of debts, instruments such as working capital and revenue-based financing.
Okay, great. Joel, what's the difference between junior and senior debt?
So junior debt is where you're saying that it'll be behind potentially. When you think about junior and senior debt, we're talking about a debt waterfall. So it's who gets paid first. Junior often will get paid later, so it's almost like the smaller debt. It's not going to get paid first. Senior debt will be paid first in the waterfall. So usually when you think of a waterfall, maybe let me define that. It's the way of kind of how is cash going to flow out of the business if there's a liquidity event. So if we raise equity or you exit, you will say, okay, cool, we'll pay out our shareholders, but you will have to pay out the debt first. So you'll pay out your senior debt first, then you'll pay your junior debt, then you'll pay your preferred shareholders, and then you'll pay your ordinary shareholders. So it's always good to think of when you're taking on any kind of debt, at what point do you need to pay that out? So does it sit ahead of you as a shareholder? Does it sit behind you? And it's always good to remember that preference shares, they actually sit ahead of ordinary shareholders on getting paid as well. So that's kind of the way I think about it, is junior, you're not getting paid first. Senior, you get paid first.
Yeah, thank you. And of course, Joel, the way you sit on the liquidity table, it depends on the return expectations that you get. And so, if you take equity position, you will last to be paid, and therefore you expect a much higher return if you were senior debt, of course, right? Olu, tell us about mezzanine financing, because this is sort of a hybrid. So how does this hybrid work in our world?
I think it's the main function is where you have potentially, and where I've interacted with is where you potentially have a longer term source of equity funding coming, and that's delayed for whatever reason, and you need something like a bridge in between. I have had one of our portfolio companies that had to do that. Had major term sheets from an equity investor, but they had to demonstrate certain results and hit certain thresholds to do it, right? And they didn't want to access equity at their current level, because then it would affect sort of valuation they will get. But however, if they demonstrated this level of revenue and ship those products, then they will be fishing in different water pretty much. So that's why they've accessed them as an index, just to tie them over where they are, over to the period where they're now able to access the equity or whatever other financing. So it's like a bridge in between.
Yeah, and then maybe just to add, so as you have a mezzanine product, if your debt schedule doesn't have certain covenants, so you're not meeting certain of your commitments, your payments, that it could trigger the conversion of that debt or a portion of that into equity, and then you would want to either negotiate that upfront, what those triggers are, and so it could be repayment of a loan that hasn't been met for 3 months, and then what is that equity bit. All of these things needs to be negotiated up front, I think. And then you could get into the last round or what the current valuation of the company is at the time. But the point is, a lot of those require a lot more discussions around very intricate details. And so I think a debt negotiation requires quite a comprehensive term sheet. You want to get experts in the room with you, predominantly lawyers that understand this. And you almost want to, if this is your beginning of the journey, get people in that work with it just to help you understand the different concepts. Great. So now we've covered anything else? Any other definitions?
I wanted to just point out how when you're talking about mezzanine, sometimes it becomes that convertible, and you need to, as you say, really understand when does that convert very upfront. We've chatted to some SMEs where they've raised what they thought was equity financing, and then suddenly it turns into debt financing because your investor has the option to switch between sometimes. So it's just understanding kind of what is that upfront, and at what point does this become equity, and at what point does this become debt?
Great point. Thanks, John. I want to focus on why debt is important again for startups, right? So let's just get into the details a little bit more. Is when do I raise debt, right? Let's say I am a seed stage company, I've got $25,000 MRR. I've got traction, I've got a good sales pipeline, I'm in good health. I've got the option now to raise a seed extension. Maybe I'm raising 2 million and I'm raising it at a 12 to 14 million valuation. But then Jill comes to me and she says, do you know about debt, right? So maybe let's go this time around. Like, when is debt an option for an early stage company?
I will say debt should be an option for you when you reach capital efficiency. So it's not really a function of the stage. So let's talk about margins on your business, right? Whatever it is you do. So typical startups, if you're a software or a fintech and you're trying to develop the product, you want it to be sticky and you're still burning cash, right? That means whatever is coming in is significantly below what you're spending, then you're not in a prime position for debt. But you could still be early stage, but you've reached a place where you're cash flow positive and your business is capital efficient, right? And it essentially means at that point in time, giving out equity becomes more expensive for you. But there's a thinking that because you're small, like you said, 25K MRR, it shouldn't preclude you from accessing debt, provided you're capital efficient and you know that you can cycle the debt multiple times in a year if your revenues come in monthly, weekly, by monthly, whatever it is. So it's really about hitting that efficiency, and whatever it is you get in the more expensive equity, you're using it to broaden maybe it's R&D and other things to broaden the base. So it's a question of where you are. And the interesting thing about that is the businesses that are very capital efficient, profitable, are the ones that qualify easily for the debt. And I find out that the guys who are not readily very responsive. They don't want debt. We have a portfolio company that, a debt provider has reached out to them, didn't get any luck, and came to me and was like, look, I want to give these guys $20 million. I'm like, I know why. They're printing more money than they can spend. So it's really about your capital efficiency. And with the drought of capital we've seen over sort of the past 2-3 years, people now understand that what you're building ultimately has to be a business. It's not a fundraising machine. You're not just going to keep burning cash and raising money. So when you get to that place where you can demonstrate, break even and cash flow positivity, then your margins are good enough to cover the interest or whatever repayments you have, then I think you're primed for debt financing.
Nice. Any other comments?
Yeah, it's Egla, my co-founder, she always says that your business will tell you when you need debt. And it'll be, okay, you've got a large order from a customer and you don't have enough working capital to cover and build out the products that you need there. You need to be buying equipment to enter into a new space. All of the things that become a short-term need, where you know that you can turn that over quickly into revenue, that is what you should be using debt for. So even if you potentially are still a startup that's still raising equity to fund out your tech build out, but for example, maybe you've got a diagnostic center that you can set up very cheaply. You should be using debt to be setting up the diagnostic center and using equity to be raising your tech. But often what ends up happening is that the equity is available. So you raise the equity and then you're plugging these short-term issues with debt, which is, you're literally taking the most expensive form of capital and utilizing it to kind of do the debt piece. And it doesn't enable you to have that rigor of, okay, how am I spending my money? Sometimes debt is a useful thing for an early stage business to say, okay, how do I cover my debt so I do get to profitability, so I can actually scale? So I think those are the things you think about as well.
Jacqueline?
Maybe just to add on to what you've both said, because you've taken the words out of my mouth, and to just emphasize on the issue around margins, need to have a solid revenue model, and just emphasize that, as a startup or as a business, you mostly live and die depending on your ability to adapt, sustain cash flow, and build a model that can adapt to market forces. So who are your customers? Because that's going to determine your revenue streams, that's going to determine your margins, and also how do you, what's your burn rate? How do you use your money? Where do you spend your money? And the reason I'm saying this is because we've seen a lot of consolidation happening in the startup world, and there was one company that came out to say, before we merged, we were burning like 2 million a month. After the merger, we've been able to, streamline, and now we're just going through 500K a month. So those are some of the things you need to have at the back of the mind, and the fact that you can have great ambitions with all the support you have and the backing that you need, but without a sustainable revenue model, then you're probably not fit for even considering debt financing, given the high costs of repayment that comes with it.
No, just to add on to Jill's point, is that the rigor it requires for you to qualify and sustain a debt position ultimately will be good for your business, right? And most people who have successfully handled the debt at any stage ultimately go on to be more sustainable businesses. So for those starting businesses early, if you could have early interaction with, credit underwriters, the things they look for will ultimately not, harm your business, subject to, what you do, whether you're a technology or you're a commodity. Irrespective of what you do, the rigor that going through that debt qualification process will ultimately be good for any type of business.
No, thank you. It's interesting that none of you use the big C, right, in debt. Collateral. So when I think about debt, do I give up my child for a 7-year period, or is my house at risk? Is my car, is my business at risk, right? So talk to us about, what do I give up in terms of taking on any sort of debt, whatever that might be.
So I'll talk about maybe unfair collateral sometimes people ask. I was speaking to a fintech that what they did is they give small working capital loans to delivery drivers. And how they ensured that the delivery guys paid them back was they got their mothers and their sisters to sign surety. And then if they hadn't paid, the fintech would then say, your mom or your sister is going into jail. And that's how they got them to pay. That's collateral that I think that's loan sharking is honestly what you're doing. I think that the collateral needs to match the business. So a lot of times when you're providing debt to early stage businesses, as you say, they're cash positive, they'll not be like your software as a service type of businesses. They're not going to be able, they often have a piece of infrastructure that they're leveraging to turn over that EBITDA. you usually will take that. So you'll say, okay, cool, how can I take 70% of your asset value and use that as collateral and then hand over the debt? You could also potentially take your trade assets, so your trade receivables that you get, invoice factoring and purchase orders. Those things are almost they're almost like pre-revenue. So you can sell some of or use some of those assets to say, okay, I'm using that as surety to help. I think what a lot of providers do is they want the surety to be that, if you're doing a purchase order, that the cash doesn't go into the business account, it goes into the lender's account, and then the lender pays the difference into the SME. What that does, though, is it doesn't create the rigor. You don't have to actually pay us. Someone else is managing that for you. Someone else is thinking about that. And when you have that, then you're not actually going, okay, but how do I manage my cash flow? How do I meet this expectation? Yeah, I'll stop there.
Hello, Jack.
It's a good point that we are talking about collateral, and a question that just ran in my mind. Like when you look at revenue-based financing, would you consider that a form of collateral because it's based on the revenue, the potential revenues?
Correct, I think so.
The other thing would be milestone-based disbursements. I think that's fair enough collateral. Yeah.
I think so too. That's a great idea. Sorry.
No, go.
What kind of milestones would you consider?
Actually, for example, and this is a unpopular opinion, when it comes to, let's look at scaling of businesses, at what point are you ready to scale? And if you are looking for capital to scale, how solid or how are you already established in the first market you're in, right? So that by the time you're thinking of scaling, you're already fully established in this other market, and it's not going to be another case of using this financing to take you to another market when you're not really well established in a single market to begin with. So that could be a milestone that before you get into another market, like, let's see, this is what you've done, you're fully established, your money is coming in, you're solid, and then we can think of how do we get you to the next market.
The shipping industry uses milestone-based quite a bit. That was startups. I also want to shift to investors and specifically talk about returns. We are raising a fund now, and a lot of our investors for the debt fund says, well, I'm investing in Africa because I can get outsized returns, which is why I'm interested in equity funds, but I don't get the same returns into debt. I want to ask you guys, what response do I give to that? But then just generally, as a debt investor in this market, what is the return profiles that investors can expect?
I think from a straight line interest rate, you will get, if I speak of Nigerian market now, the nice banks, their rates are 30 to 32% per annum, right? And the not so nice banks can be the one that asks for collateral from your mother and your sister can be 10% per month or anything crazy. I think your biggest enemy, and I touched on it earlier, is the currency.
And inflation in Nigeria?
Yeah, I mean, it's inflation. It's inflation that has driven it from, 18, 19 a year ago, an attempt to combat inflation, then the bank raises the MPR the central bank raises the MPR every time. So in looking at it plainly, in just nominal figures, you get the returns. Where you get beaten is in the foreign exchange, right? So I think it's your hedging mechanism that would ultimately help. And another thing I've seen a few debt providers do is to purely focus on businesses that have a significant portion of their revenue in dollars. Export businesses, businesses that deal with maybe multinationals and things like that. So I think those are two levers you can pull and focus on to ensure that the currency is protected, because you will get the nominal interest in the markets. They won't get the same rates subject to where you're trying to raise from. So it's how do you protect, how do you hedge against the fluctuation to make sure that the bottom line is protected when you have to do the returns versus in an equity position where you're playing a slightly different game.
Is it then just mainly a domestic product? Can an international investor invest into an African debt fund actually get healthy returns?
Well,
Yes.
Subject to
we'll come back to the
come back to the
Let's take the
Please.
yes. How?
Okay, no,
Because
she wants investors. Yes, I say yes.
when your four major economies had a currency crisis in 2022, 2023, how am I, as an American investor, going to make money on a debt fund?
Okay, I'll use Untapped Global as a nice comparison. So they're charging a very high rate in USD to their startups. So sometimes
Is that fair?
How high is high?
I'm not allowed to expose other people's rates. That's not the vibe. But the reason is they're managing the risk, right? So as you say, they're managing the currency risk, and then they're managing the fact that often they're in really tough markets like Nigeria and Egypt. They are still providing. They actually raise as they raise from their LPs in debt, and they promise a 5% US dollar return every year. So that's quite decent if you're actually thinking about that, but it's not the 20% every year or IRR that you're expected to get for equity, right? My thing to remember is that VC funds haven't returned that 20% IRR. VC impact funds haven't either. South African and globally, you're seeing that the IRR is more like 3-4%.
Yeah.
So actually there's and there's a huge outsized risk when it comes with equity, right? Whereas with debt, you can provide them with liquidity sooner so that you don't have to be sitting somewhere in an equity position for 10, 12 years, you exit it, and now suddenly you've got rands and you need to convert it into US dollars in 10 years' time. You're doing it every 2 years, say, and that helps you, I think.
Great. Jacqueline, I want to ask a question about policy, so because that's your main frame, is what do we need to do in order to accelerate the growth of debt? So, at the height, there was 5 million, 2022, 5 million of equity was invested, about 1.5 in debt. How do we get that to 5 million from a policy perspective, as an industry, people in building, investing? What do we need to do to get this agenda for a debt product to be more available, more actors in the space? What are you working on, basically?
That's a very good question, and I've had a similar conversation with some of you in this room already around the regulatory policy frameworks, and some of the questions that I still do not have answers to, and these are some of the things you're trying to find answers to, is how, first of all, on the issue around interest rates in Africa, which is like 54 countries, how do we first of all look at standardizing that? Because as a debt provider and you're investing in different markets, how do you navigate the different FX challenges? So adopting, I would say for one, finding a way to adopt to each nuanced market structures is one, but then again, this is also a question I would throw to the audience, and I would love to hear from especially other debt investors on how you are navigating such different market structures when it comes to interest rates, when it comes to hedging, questions around protection, like I had mentioned earlier. How do we build that into a policy framework that does not only just protect the investors, but also protects the investee companies, the businesses, so that there's no, cannibalism in terms of lending to these startups. So that's what I would say are some of the questions we are trying to answer. Also thinking of how do we, because it's an emerging asset class and we see a lot of potential in it, and there's also a rationale to the LP side of it, in the sense that, it's providing an added layer of protection. It's senior in the capital structure, so you have more visibility in terms of, if liquidity is an issue, you have more visibility in terms of, when to expect your cash flow back. So the question here is, how do we then build this into a policy sort of framework or toolkit or playbook that then encourages a lot more participation on the LP side, especially the ones who are very risk averse when it comes to, not wanting to wait out for the whole 7 to 10 year period when it comes to equity investments, but they see an opportunity in this. And there's a lot of potential in that to incentivize domestic institutional investors such as the pension funds who still do not want to invest in VC because it's considered too volatile and too much of a high risk. So there's a lot of capacity building approach that we have with different stakeholders, the regulators, the investors themselves, and also welcoming feedback from the investors in terms of what are the gaps and how can we collaboratively work on this. So I would say it was more a collaborative effort, and we are open to engaging further.
Perfect. I wanted to quickly get one comment from both of you is what do you think the regulators should be doing? I will start to say I think that the associations must push the Startup Act more. Now we've got one more player trying to push it. More countries need the Startup Act. And I do think that there's space for us now to engage with banks because we ultimately can be the pipeline with proper credit models behind these businesses to prepare them for the banks. But any other ideas?
I think, and there's a startup in our portfolio that has done this very successfully. I think the banks, with the best will in the world, if you have big oil companies and trading companies and you're financing them, heavily collateralized, 150, 200%, the question is, what is your incentive for going further down the line to something you perceive riskier? So what this company ended up doing is the same credit analyzing framework. They've revamped it and turned it on its head and realized that these people are actually not as risky as you think. It's just you not understanding, their business well enough. So you understand that if I want to, get an oil mining license, it's X $100 million, the crude oil prices, you understand that. But for an SME, you're not incentivized. So the thing is, for the debt providers, coming out of either you call them, the SME world or the startup world, is to create the framework to understand these businesses and be able to underwrite them very well. Because actually, from what I've seen from the banks that lend to the startups and SMEs properly, their NPLs are actually way lower. These guys are not as risky as you think they are because they know the implication of not paying back. Yeah. And this is Africa, the social pressure, the collectives, if you come, to get, exactly, they don't want one person to spoil the reputation, so they all lean on you to make sure you perform. So you need to have someone wearing the lens and seeing them through a different lens, and ultimately, catalyzing that space more.
Joel?
Okay, I'm going to say something a bit out there.
You haven't before.
I think that you should take some of the. So one of the major issues that you've got in the banks here is that they don't credit rate the SME, they credit rate the person. But you've got the Lulas and the merchant capitals of the world that have amazing black boxes of credit scoring that they're doing with SMEs, and they're iterating on it in an online distribution channel. And Lula's, non-performing loans is low. So is merchant capitals. If I was a South African regulator, I would say, I think maybe we should take that black box and shine a little bit of a light on there and actually create some regulations around this is what we've seen work, you have the data, provide it to us, and then we'll create a National Credit Act for SMEs that actually works for them.
Great. I think we are out of time as she's walking to the stage. Thank you, everybody. I hope that was a good conversation about debt. Debt is healthy for your business, so don't shy away from it, and all of them are providers. So thank you for your time.